Welcome back to Sip and Talk.
And hello from me. So glad you're joining us today.
Things are moving fast out there, aren't they?
It really does. Today, we're pouring into some pretty big headlines. We'll get into what's happening with global trade, those Trump tariffs everyone's talking about again.
Right.
Then maybe zoom out a bit to the broader economic picture. And then we're diving headfirst into the really fascinating world of tech ETFs and, how AI is just shaking everything up there.
Okay, sounds like a plan. But first, just a quick heads up for everyone listening.
Yes, the important bit.
We are definitely not investment experts, not at all.
Nope.
Our mission here is purely to pull together the latest info we can find, try to present it objectively, and, help you make sense of it all from an international perspective.
Yeah, exactly. Think of us as your curious guides, maybe, not your financial advisors.
We're just trying to connect the dots with the facts. What you do with it is, well, up to you.
Independent thinking is key.
Mm-hmm.
Okay, shall we start with the trade stuff?
Let's do it. So the immediate pressure point seems to be President Trump's threat, right? A potential 30% tariff on the EU and Mexico.
Yeah, that's the big one looming. Set for August 1st, 2025, if they don't reach new trade terms. That kind of threat really shakes things up.
How did the markets first react? I remember some weird buzzwords.
Right. Well, initially there was talk of the taco trade.
The taco trade. Sounds delicious, but probably isn't.
Huh? No, not about food. It was basically this speculative rush shipping. Importers hurried to get goods in, sort of betting the tariffs might not actually happen, or at least not fully.
Okay. Creates a temporary blip in the numbers.
Exactly, a distortion. But overall, the market mood has been pretty cautious, actually. Trading volumes have been lighter than usual. People are kind of waiting and seeing.
And you can feel that uncertainty here in the U.S., too. Bond traders, for example, they seem to be wavering a bit on whether the Fed will cut rates in September.
Yeah, that confidence isn't as strong as it was.
And gold prices ticked up, didn't they?
They did. Classic safe haven move. When things get shaky, people look for stability, and gold often provides that, or at least the perception of it.
So what about the EU? Are they just taking this?
Oh, definitely not sitting idly by. They're actively working on new trade deals, looking towards countries like Japan and Canada, building buffers,
Smart, hedging their bets.
And they're not just doing that. Reportedly, they've prepared a pretty hefty retaliation package.
How hefty?
We're talking potentially 2 or 3 times the size of existing measures. It's a serious counterpunch.
Wow. So they're basically signaling, don't mess with us.
Pretty much. The EU Commission's philosophy seems clear. Trade helps everyone prosper, and going it alone, isolationism, ultimately benefits no one. They're ready to make tariffs painful if they happen.
What else are they worried about?
Well, there's concern about China's spillover capacity. Basically, China making way too much of certain things, which then floods global markets.
Like electric vehicles, maybe?
That's a prime example. Plus, worries about bottlenecks for critical raw materials. Think rare earth elements, stuff we need for all our tech.
Right, so they're calling for dialogue, trying to avoid a full-blown trade war.
Exactly. Responsible dialogue is the key phrase they're using.
Okay, let's pivot slightly. U.S.-China relations, still incredibly complex. Any signs of change there?
Well, there's been some chatter about a potential Trump-Xi summit. Secretary of State Marco Rubio mentioned constructive talks happening in Malaysia.
A summit. That would be pretty high level for this administration.
It would. The highest, actually. It signals maybe a slight move towards stabilization, even if it's, fragile.
Any concrete signs?
There's some hints. Possible easing of export controls on things like rare earths, maybe even jet engines. It suggests both sides are trying to manage the tension, not just escalate it.
Interesting. Does that connect to China's recent trade numbers? I heard they saw a bit of an uptick.
It does seem linked. Their June trade figures show the first positive export growth since February. Part of that seems to be thanks to a temporary 90-day trade truce that was signed back in Geneva.
So a little breathing room, perhaps?
Maybe. But the market's view is pretty clear. The U.S. and China are just too intertwined, even if the long-term goal is some kind of decoupling.
Which sounds easier said than done.
Oh, way easier said than done.
Yeah.
It has to be managed super cautiously. It's like trying to untangle two, really complex sticky knots. You pull too hard in one place, and the whole thing gets worse.
Good analogy. Now, speaking of China's complexities, what's this involution thing I've heard about?
Yeah, involution. It's this intense, often really unproductive kind of cutthroat price competition happening, especially in the private sector.
Like where?
Think electric vehicles again, or even food delivery. Just brutal price wars that don't necessarily lead to better products or services, just squeezed margins.
Why is that happening? Is it different from past issues?
It's trickier than, say, past reforms in state-owned industries like steel or coal. This time, it's private companies.
Right.
And you have local governments acting almost like venture capitalists, trying to prop up struggling businesses to protect jobs.
So companies that should maybe fail don't.
Exactly. It makes it really hard for them to exit the market gracefully. It creates this kind of economic limbo almost. Very different dynamic. Imagine like 5 coffee shops opening on the same tiny street, all slashing prices until nobody's making money, but none of them can afford to close. That's kind of the vibe.
Yikes. Okay, let's zoom out regionally for a second. Australia seems to be in a tricky spot.
Definitely. PM made as he visited China, aiming to deepen economic ties. But then you have U.S. media reports suggesting Washington wants Australia to, quote, choose sides regarding Taiwan.
That's a classic diplomatic tightrope walk, isn't it?
Absolutely. And Albanese's been very careful, acknowledging China as the biggest trade partner, but the U.S. is the most important strategic ally.
He's basically saying, we're not choosing.
Firmly stating they won't choose sides. And look at the numbers Australian exports face. What, 10% tariffs go to the U.S., but only 1% going to China. That highlights the huge economic pressure they're under in this balancing act.
That 10% versus 1% really puts it in perspective. Any other quick regional notes?
Just briefly, India and the U.S. seem close to a temporary trade deal, though there's some background noise with BRICS policies maybe causing a bit of uncertainty.
Okay.
And South Korea's June exports were strong. That's often a good bellwether for how Asian trade is doing overall. So yeah, it's a very interconnected, complex global puzzle right now.
Definitely feels like shifting sands everywhere. Okay, let's shift gears ourselves. From trade tensions to the tech world, which is having its own kind of revolution, right? Driven by AI.
Oh, absolutely. A massive shift. And it's making people question the old ways of analyzing the market.
How so? Like the traditional linear thinking based on past performance.
Exactly. Many experts are arguing that AI, semiconductors, software, they're not just growing steadily, they're set for potentially exponential growth, a new normal, they call it.
Exponential. So much faster than historical patterns would suggest.
Way faster. Think about how fast internet speeds grew over decades versus how quickly AI capabilities seem to be expanding year over year now. It's a different kind of curve.
So does that challenge the old big tech always wins idea if innovation's moving that fast?
It certainly could. Even giants like Apple or Google aren't automatically guaranteed to keep dominating indefinitely. They have to keep innovating at an incredible pace, or they risk getting leapfrogged.
Which brings up the question of valuation, right? Because tech stocks are, well, they're not cheap.
They're definitely not cheap. The valuations are high. You look at something like the XLK Tech ETF, its forward price-to-earnings ratio is up there, even if it's dipped a bit below 25 times recently.
So with those high valuations, what's the main risk? What could make people rethink these exponential growth assumptions?
The biggest risk is probably if that growth starts to slow down unexpectedly, or maybe increased regulatory pressure. That's always a possibility in tech.
But if they do keep delivering,
then they can still outperform. If companies consistently beat profit expectations, even with high PE ratios, the stock price can keep climbing. It's like, paying a premium for a truly top-tier product, you expect to deliver exceptional results. You're betting on that continued innovation and execution.
Okay, let's get specific. Individual companies, as of, say, mid-July 2025, how's Apple doing in this AI race?
Well, the sense is that Apple's AI progress has been maybe a bit slower than some others. They launched Apple Intelligence, but the market feedback seems to be that it's still playing catch-up a bit with Google and Microsoft.
Could that affect their dominance, their premium pricing?
Potentially, yeah, in the long run. There's this view that maybe their current strength is more in scaling existing ideas really well, rather than that fundamental 0-to-1 innovation in totally new fields like AI.
Interesting point. What about Google? Is ChatGPT still breathing down their neck in search?
The threat is definitely still there. AI models pose a real challenge to traditional search. And the cost of AI-powered search is a huge factor.
Oh, huge.
Some estimates say it could be 10 times more expensive than traditional search results. That could seriously squeeze profit margins maybe from like 90% down to 30% for that part of the business.
Wow. So the question is, can they make money from it differently?
That's the key insight, yeah. Can they monetize it through new services, premium features, something beyond just ads? But their big buffer is Google Cloud. That's growing strong, around 30% revenue, which helps offset some pressure.
Okay. Then there's NVIDIA, still the king of AI chips.
For now, absolutely. Demand for their chips is still incredibly strong, but competition is rising.
From who?
AMD is definitely stepping up, and you're seeing more specialized ASIC chips being developed.
But NVIDIA has that CUDA ecosystem, right? Isn't that a big advantage?
It's a huge advantage. CUDA is their software platform, and it makes it much easier for developers to build AI using NVIDIA chips. That creates a really strong moat. But still, growth in certain segments might slow down a bit as competitors gain ground.
And finally, Tesla, always in the news. What's their AI angle?
Short term, they've got pressure, especially from Chinese competitors like BYD. No doubt about that.
But the long-term play?
That's where the AI story really is. Full self-driving, robotaxi, the Optimus robot. Those are the big dream businesses. But the consensus seems to be that those are still, 5+ years away from showing really significant value.
So it's investing in the future dream versus the current, sometimes messy reality.
Exactly. It's a bet on that long-term vision playing out.
Okay, that makes sense. Let's talk ETFs then, because they offer a way to get exposure without picking individual winners. As of mid-July 2025, which ones have been doing well?
Well, looking at the past 6 months and year to date, SMH, that's the VanEck semiconductor ETF, have been the standout performer.
Makes sense, given the AI chip demand.
Totally reflects that. But others have done well too. QQQ, the NASDAQ 100 tracker, XLK, the broader tech sector fund, and IGV, the software ETF, have all shown strong performance.
So if someone's listening and thinking about this space, break down what each of those actually focuses on. Why might you look at one over another?
Great question. Let's unpack them quickly.
Go for it.
Okay, QQQ. That's your broad NASDAQ 100 exposure. Big tech names like Apple, around 9.4%, Microsoft, almost 8%, NVIDIA, about 7.5%. Good for overall tech growth, gives you diversified AI exposure. Its NAV was up nearly 18% in Q2, beating the S&P 500.
Okay, broad tech. Next.
SMH. This is the semiconductor pure play. Heavily weighted towards NVIDIA, like over 20%, and TSMC at nearly 11%. Directly rides the AI chip wave. High growth potential.
But also higher risk, probably.
Definitely higher volatility comes with the territory.
Got it. What about XLK?
XLK. This tracks the S&P 500 tech sector, still big on NVIDIA, around 15%, Microsoft 14%, Apple almost 12%. It's maybe a more stable blue chip way to get tech exposure compared to SMH. Still benefits from AI, but a bit broader.
Right, less concentrated.
And IGV.
IGV. This one focuses on software companies. Think Oracle, nearly 10%. Microsoft, again, around 8.5%. Palantir, also about 8.5%. It's driven more by AI applications and cloud services. And interestingly, it's shown better risk-adjusted returns than QQQ lately.
Meaning what? Good performance for the amount of risk taken.
Exactly. Good Sharpe and Sortino ratios. So appealing if you want growth in AI software, but maybe with a bit more stability factored in.
Okay, that's a helpful breakdown.
Yeah.
So SMH for the direct AI chip bet, QQQ or XLK for broader tech growth, including AI, and IGV if you're specifically interested in the software side of AI. It lets you tailor it a bit.
Precisely. It depends on your risk tolerance and where you think the biggest opportunities are within the whole AI story.
So quick outlook, short term, long term.
Okay, short term, maybe the next 6 months. If you think the AI semiconductor boom continues full steam, SMH has that direct exposure and momentum. QQQ and XLK are more balanced place.
And longer term, say 1 to 3 years. Looking out further, AI, cloud, software, semiconductors, these seem likely to remain the core themes. The chips and infrastructure, they're kind of the first movers, right? They enable everything else. But software is proving incredibly resilient and finds ways to integrate AI across the board.
Got it. And let me jump in with the reminder again. We are not financial advisors.
Absolutely critical reminder. This is all just information based on research available around July 2025.
It's meant to help you understand the landscape, the trends, the conversations happening. Always, always consider your own situation, your own risk tolerance. Do your own thinking.
Couldn't agree more. And maybe, as we wrap up, here's a final thought to chew on. Or step on.
Lay it on us.
Beyond the chips, beyond the software, what's the next big AI breakthrough going to be? The one that really reshapes our daily lives in ways we maybe can't even predict right now.
Ooh, that's a good one. Something to ponder indeed.
Definitely something to think about.
Well, that was quite the journey. From global trade jitters and tricky diplomacy, all the way to the, frankly, mind-bending speed of AI development in tech. We covered a lot of ground today.
We really did, and hopefully we helped distill some key insights for you. Remember, our goal here at Sip&Talk is always to give you the objective facts as we find them, and just encourage you to think critically about these big, complex topics.
Thanks so much for joining us on this Sip&Talk.
Yes, thank you. And hey, before you go, please remember to subscribe to our podcast, Sip&Talk.
Definitely.
And seriously, you have to check out our old friend Mickey's YouTube channel, Mickytolife. His final episode from his trip to Cheongju, Korea, just dropped. I swear, I almost died laughing. It is absolutely hilarious.
Oh, yeah. Sound like a must-watch then.
Totally. Go check it out, Mickytolife.
You won't regret it. All right, see you next time on Sip&Talk.